Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, April 23rd, 2019. Wanted to do a quick market update. There's not a whole lot of new, or at least not any significant technical developments to note. The Q's punching up to new highs again, but SPY or the S&P 500 just a little shy right now. But again, to be expected when you get that close. The important thing is we're watching these trend lines. So as of now, and it's really, the video doesn't even warrant an update because nothing changes until at least you see a impulsive break and solid close below these uptrend lines off the lows on the 24th. There's QQQ divergences are still intact, clinging on by just a hair. We're close to making equal highs, or probably right about at it there. So that's that on the Qs. But and of course you want to watch tech. It's all about tech really holding things up here. XLK, and again, XLK has a little bit bigger buffer above its uptrend line, again off the lows here on December 24th. So that's the story. Overbought with divergences. In fact, we're more overbought now. We're at extreme overbought readings. So look, until we have sell signals, the trend is up, and there's no not anything in the charts that tell you short now, except if you want to take a shot at the dark. Because when things finally turn, whether it's going to be some of the earnings that we have here soon, or whether it's going to be a blow off top that drives us up a little bit more, a couple more percentage points, it's going to come quick. Because when you get this overbought, just look at the overbought readings. That's just a regular overbought down there. This is the extreme overbought level. The corrections are usually very powerful off those overbought readings. Here's a case where you're overbought, and each time you hit overbought, you correct it. You can see the overbought, the red line's overbought. I put a purple line here at the extreme overbought level. And sometimes you become overbought, and you have these little corrections along the way, like you have here and here. And then you're just building one larger divergent high, and finally all those divergences have been building and only playing out for relatively small corrections. All the overbought conditions, extreme sentiment, they play out for the bigger drops. So point being that once this goes, if a lot of eyes are on that, and the algos will kick in and everything, it might be quick, and it'll probably, my guess is it probably won't break intraday. It'll probably start out with a move down in the futures overnight, and then a gap down below that level. Why? Only because this is such an extended run and things like that. That's the way the markets tend to work. They tend to deny longs that have been riding the trend up an objective exit out. Otherwise you could just keep trailing a tight stop, and it has been working well if you've been trailing a stop up. And if you're short and you're waiting for that breakdown, who knows, maybe you'll get it. Maybe you'll get an intraday break, and then you can short it and wait for an intraday close. But again, right now the trend is up, and not even anything remotely close to a sell signal. So let's not spend much more time on that. Let's just watch those levels. I have alerts set. Same thing on the FANG stocks. They all have a similar trend line, and as I've said, when one goes, they're all probably going to go, at least the vast majority. And I'm talking about XLK, QQQ, SPY. We already had that breakdown, but I talked about that last week. It was not confirmed for two reasons. Number one, it wasn't impulsive at all. We barely closed below there and no follow through. And number two, and more importantly, we didn't break down on, to me, what is much more important right now, the tech sector, XLK, because that's the largest component of the S&P 500. Until that goes, the market's not going to roll over, just like back in last fall. There it is. It's actually back testing there. So there's a little back test on the SPY. Interesting. So we'll see what happens. Think about a back test. Sometimes you continue to back test. New highs are within, a stone's throw right now, but they're not there yet. So again, it's just, to me, anything is possible, but it's more a matter of, are you going to pop just above it and briefly and come back down, or are you going to hit it almost perfectly in reverse? I don't know, but I still think, in same thing, kind of slow grinding up. The range, the upside potential based on everything in the charts is relatively limited before we get a tradable pullback, or possibly more. We'll see. Okay, and not to do a specific update, I actually am going to do an update on trade ideas. I have now a growing watch list of long and short trade ideas that I'm going to do a video, and probably do that today after this one. I wanted to get a general market analysis video out there, and also to talk about that. Remember that the trade ideas have never been this light for this long on the site. And that is a function of the market. The market's just not conducive to swing trading now. It's inching higher. The risk reward is not attractive. And so, I continue to just focus where the opportunities have been are on things that don't have a strong correlation to the broad market. So in other words, back out the 11 sectors, give or take. There's been some movement lately, some disconnect. We're finally starting to see some sectors kind of go the other way, but for the most part it's been a one-sided trade, just money flowing into the market in the sectors that make up the S&P 500, particularly tech. But where I've been looking, and these are all the trade ideas that have been on the front page. A lot of these unofficial because they're very, like the shippers, for example. This was one, and this was back when it was posted here, NAO, one of many, just a few weeks ago. Going up to these targets here, 373, and then if it can take out 373 up here, and that's what's moving in making. That's where you're making money right now in the market, is things that aren't really highly correlated with the stock market. So NAO, you can see since then it broke out, and it's already run, I don't know, 30% or more, and kissed that first target to the button today. And you can see I also had that resistance level at 310. Broke out, came and back tested. So if you missed the initial breakout, you have plenty of opportunities here testing 310 and now at 373. And I could go through all the shippers, but I'm not going to do that here. They're all on balance. The ones that I've highlighted, and again, here's an important thing. There's a big difference between a trade setup and an actionable trade. But the shippers, not all have taken off, but the vast majority, and we're talking gains in the low to even high double digits. Some of these are up over 50% in very short order. Another example here was Zine. This one was posted both on the front page in the trade ideas as well as in the trading room. First in the trading room, that looks like back on, this was the original trade setup. And this is the example I wanted to make about two things. Number one, where the opportunities outside the stocks that trade very highly correlated with the broad market. In other words, your Apple, Facebook, Amazon. Those are going to trade because they're top components of the QQQ and SPY. Zine's a little biotech. Now, very aggressive. And at the time I posted this, I had just done a video talking about how aggressive it can be when you're trading individual, especially smaller biotechs, because of the risk of clinical trials. You trade Amazon, your biggest problem, for the most part, your biggest worry is a earnings report or guidance that goes against the stock. But you see that coming a mile away because every quarter they pre-announce, when earnings are going to be, so you have an opportunity as a trader to either get out of your position or hedge, or at least hold off if you're considering a position. Biotechs, yeah, they report every quarter as well, but the problem is they have clinical, especially the smaller ones, have drugs in clinical trials that can make it or break it. And you wake up one morning and you check on a stock like this, we're up 75% since I posted this setup. It broke out right after that. Here, let's pull it out. So I had it going up here to these targets, eventually to that 1134 level. It was at 563, just poised to break out at the time. And so far, I think it's climbed about 75% since then. Beautiful breakout. And what I said you wanted to see, it was a setup, but it broke out the next day. That's an impulsive breakout, that big green candle right here on high volume as well. See the volume down there. So that's everything you want to see in a breakout. And then if you missed the breakout, or even if you did, you had an opportunity to add or come back in and a second shot at it when it back tested that same trend line for about a week or more, and then off to the races. So again, about roughly 75% or so since then. And hit that 870 target, had a pull back to that 775, all the same levels that were there before. So these trade well. That's the good thing about biotechs. As long as everything's going their way, the risk and reward is very high. You've made 75% in a month. It could have gone the other way. So how do you manage that? You just keep your position size small. But again, the takeaway is trade ideas. This is best I have right now. A lot of these obscure names that have nothing to do with the broad market, very little correlation, and that's where the money's to be made lately. The broad market too, but we're up. I measured it today. I think in the last 1.5 months, the S&P 500's gained about 3.5% or so, 3.6% from where it was a month and a half ago. So really it's just inching higher, relatively speaking. So, shippers, the auto parts stocks, which, many of those also high double digits, low to mid to even high double digit returns on those. Okay, so anyway, I'll follow up with a video on some of the longs that stand out right now, and then a separate video on the shorts that stand out as well, because there's setups on both sides. And some of those are actionable right now, so I'll try to get to those as soon as possible. And I've also been posting some of those in the trading room as well. All right, here's something I just want to point out and watch. Keep an eye on the Italian 10-year bond, even if you don't have on your charting service. If you can't track it, you can go to investing.com. They give you a free charts. You don't even have to have an account with them. You can create one, and I think they give you a little bit faster loading charts and stuff. But what I wanted to point out, let me get rid of this. I'm trying to get rid of the drawing tools there, is the 10 years. So I was reading, I think it was Barron's over the weekend, and they were talking about, potential ticking time bomb. I don't mean to sound like a doomer, gloomer, or zero hedge or anything. It's just something to monitor. Right now, it's not a problem, but it could be. And they're talking about Italy. Now here's the problem. So what you want to watch first are the Italian bonds. Anytime you especially it's a developed country most certainly, but you want to watch the Italian bond yields, because that can tell you if there's trouble brewing. And now the issue is this: everything's been turning down there, slowing down. And if that trend continues and Italy sinks into recession, what historically has happened is a country, including the U.S., and economy turns down, what they'll do is the government will take measures. They'll print money, come in, the central bank will start printing money, inject it into liquidity into the system. That's what we did, quantitative easing, and they'll also usually implement some fiscal stimulus, such as construction and infrastructure projects, build bridges, schools. That hires people, gets jobs, gets the economy moving again, because the private sector is can't do that. They're trying to just stay above water. Many businesses will go under. So it's usually the government that helps try to pull things out. However, the problem with the Eurozone is there's a catch-22 there. There's a problem, and that is they kick in, austerity measures have to kick in, and Italy can't. They don't have the option to just start printing money and spending a lot of money to spur growth because of the covenant and the restrictions in the Eurozone. So therein lies the problem. So as we all know, they've already got enough to deal with Brexit and some other things, but this is one to watch. And so what I did, I just read about the fundamental issues over there, but the chart, so I pulled this chart up, and it's pretty clear to me. You can see my markings on the chart, basically what happened, the time frames down here. So where is 2019? There's the start of the year. Here's 2018 was right here. So you can see last year there was a big surge in Italian bond yields, and that not surprisingly coincided with it started shortly after we had some corrections in the U.S. market, and but that's a big rise. Since then, yields have abated. Now, that was a good sign. However, you can see, as I've drawn here, we have this wedge type pattern right here. It was a downtrend line. We had a divergent low right there. You can see the divergence drawn on the indicators down below, MACD, RSI, and then we broke out. And so right now, we have resistance around the 2.7-ish level. So there's your yield, about 2.7% on the Italian 10-year. If that gets taken out, and this chart pattern would indicate it. Here's a bullish falling wedge. If you just take the widest part of the wedge from here to here, that gives you a measured target. So if I were to copy that line, add it on to where the wedge broke out, that would tell me that it's probably going up here to this 3%-ish target, about 3% or so. That would be concerning. Of course, if it goes beyond there, which it certainly could, even worse. So just something to keep an eye on. If yields abate, that's a good sign. Maybe we come in a back test. We still have support here around a pretty decent support level 2, which would be bullish for Italy if that level broke. Why? Because the yields are going down, and therefore your market doesn't perceive Italian bonds as having such a risk. So that's the bullish scenario for Italy. And again, where it plays in, you might be saying, Randy, I live in Topeka, Kansas. What does that matter to me? Well, it all matters. There was a chart here. Let me see if I can find it for you. Hold on one second. Okay, here it's in here somewhere. This is from the journal today. That's City Economic Surprise Index showing that's slipping down. These are just economic indicators. Market PMI pointing to slower GDP growth ahead. But here's the one I wanted to show you. Right here. Nope. That's the, where is it? Okay, I knew I had it here somewhere. The correlation between U.S. and global indicators declined recently, but remains highly elevated. So, the point being, the U.S. is, as it says here, U.S. is connected to the world economy more than ever. So make no mistake about it. Sometimes we had some big outperformance compared to a lot of other developed countries over the last year, but make no mistake about it. If Europe goes into a hard recession, they have a lot of problems. It's going to spill over to us. We'll have some problems as well. So that's why you want to keep an eye on Italy. There's a lot of things that could be the spark to something bigger. Okay, and finally, let's wrap this thing up. Talk about the low volume recently, which is a concern. We've had some deterioration in market breadth, market internals. Also, you look at yesterday. Here's QQQ. I'm zooming in real tight. Let me get off these lines. Look at yesterday's volume bar. I noticed that during the day. We had, and it wasn't a holiday or anything. I can't even see. I'm going back in time. You can see where I put the crosshairs on the top of yesterday's volume bar. We haven't had volume that low since, I can't even scroll back that far. We're probably going back a year or more. Today it's a little bit better, but here's what I wanted to show you. I recently covered this. These are, no, it's right here. No, one second. Okay, so I'll wrap it up here regarding the volume. Something I've shared this in the past, going back for years. And again, at different points in time in the market, there's different levels or thresholds. So what I do is I like to put on an EMA either anywhere from a 5 to a 10-day period exponential moving average on volume. That helps smooth out the bumps. You're going to get your days like yesterday. We had an extreme low, or you have a holiday session, and so you're going to get those brief lows. So by using a moving average, it's 10 days. It's going to smooth it out, and it shows you the trend too. And what it is, it just tells you, a healthy advance, should have some volume behind it. When volumes taper off during a rise, that's when you need to take note. So we're just going to look at it. So the red line is placed roughly about, actually a little above where we are today. We're roughly doing about 24 million shares or so right now, but or that would be no more than that, a lot more than that. The low volume, here we go. So we hit that level. This is going back 2 years, and then boom, we had a pretty sharp correction. So we'll just follow down there. So there was a correction when volumes fell to that level. We crossed through it here, and here's the thing: it is not a buy alone, buy or sell trigger. It's kind of like if you the way I look at overbought, oversold. Overbought conditions can stay overbought for an extended period of time or become more overbought. But more often than not, they usually result eventually in a correction, just like oversold results in a bounce. So here you go, right here. All right, so we became overbought, and I'm sorry, not overbought. We dropped through the low volume threshold. We hit it right about here, and there was a correction right about that time, a little one. We did it again, but this was a strong period. This was a very strong advance. So what you can see here is we stayed persistently, we had persistent low volume around that level for a while. And it didn't really, it led to a few minor pullbacks, but then suddenly we had the largest drop in, what was it, over 2 years, I believe. Remember, that was late January 2018. There's January right there. Boom, market wiped out. I think it was like a 12% drop in short order, and that came after that persistent low volume at that level. Okay, so we, things began to rally then. We did have another, follow-up retest of those lows, but for the most part everything chugged along, volume returned to normal. Came back to that level here, but it really didn't do much right away, but it did after, what is that, just about a month, a few weeks, we did have a correction. Notable correction too. Hit it again there, you can see another correction. Hit it again here, not just a correction. So this was another persistent low reading. Sometimes you get them kind of one and done, you get a correction, or at the very least, maybe we get something like that here. But it's worth noting each of those did result in little corrections. And finally, after that persistent low volume right there, down to the red zone, that was it. That's all she wrote. There was that 20+% drop we had in the third quarter following that period of persistent low volume. The last tag of the level really triggered it. There was a high right there, pushed down, failed to make a new high. Volume stayed low, boom, bottom fell off, volume picked up. Now, look, so we hit it here again. And it's not as if it didn't tell us of a correction. Again, this whole story of 2019 is we've had, sell signals, trend line breaks, even some bearish chart patterns. They all played out for something, but much less than you would have expected. We're talking the tune of, 2-3% a lot of these pullbacks, but yet it did warn of that. Bottom line is we're there again. So take it for what it's worth. We haven't had anything remotely close. So this market's now looking, QQQ is going almost parabolic here just from recent days. Don't mean to, overdo that. We're only up a little over 1%, 1.3%, but again on dangerously low volume. And I struggle to go back in time and find anywhere where that was very bullish. But again, it's not a sell signal, just something to watch. And we can look at SPY. SPY, you can see the same kind of thing. I might have to lower the line a little bit on SPY, play around with it. But again, so we've crossed down to a level now. Last time we got close right there, we had a little correction there. We stayed persistently low leading up to the top in 2018 before the fourth quarter drop. And the same thing, we were down low volume heading into the highs back in January 2018 before the big drop there. So something to note, keep an eye on right now. So that's it, guys. Lots of red flags, but absolutely no sell signals. So take it for what it's worth, and no reason to fight it here, but certainly a reason to just be on alert. And finally, what I'll say is where all that plays in, because somebody asked me today. They posted some things about this is one of the few times I think the article said that the NASDAQ had punched out to new highs with more stocks at 52-week lows than 52-week highs, if I remember correctly. It was something to do with negative breadth. Everything I've talked about, the declining internals recently, fewer and fewer stocks lifting up. And I said where I factor that in for what it's worth is the magnitude of a move down. If we didn't have that, if we didn't have a lot of signs of non-confirmation, low volume, negative breadth, extremely overbought conditions, at that point I'd probably be looking for a pullback, a relatively minor pullback to go long, say a drop right here, about 3% or so pullback, and go long. But where all that factors in into the analysis, taken in with everything else, is that when it finally plays out for a trend reversal, when those trend lines break and everything else, you're probably looking at much more than just that, what is that, about a 4% pullback down to that 183-ish level. And again, I'm just picking a, one potential stop right here, possible support level. So we'll see. But again, first things first, and that's to wait for some type of sell signal, or even some type of bullish developments. Pop on through here, come in, back test. Take out the divergences, maybe consolidate a little, give a healthy advance. Do a minor pullback. Surprise me. Do that. Come in here, Mr. Market. Do a pullback. Hold that level. And then blast on up to new highs, clear out some of the extreme overbought conditions, clear out the divergences. Great. But as of now, the potential is there for quite a bit more if and when the tide finally turns here. Okay, this has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.